You spend weeks coding an EA, backtesting it, optimizing it, only for it to completely collapse 3 months later in live markets. Here's the brutal truth. A single expert advisor, no matter how clever, is mathematically doomed to fail. In this video, I'll prove why relying on just one EA will destroy your account and show you the exact portfolio framework that took me from blowing challenges to securing consistent payouts like these. We're covering the math of decorrelation, market regime shifts, and how combining simple EAs creates an unbreakable equity curve.
To understand why single EAs fail, we need to talk about market non-stationarity. Financial markets constantly cycle through 4 distinct regimes: trending, ranging, high volatility, and low volatility noise. A trend-following EA will print money during strong momentum, but the second the market compresses into a range, it gets chopped to pieces. On the flip side, a mean reversion bot dominates quiet markets, but gets wiped out during sudden news events. When you trade a single EA, you are betting that market conditions will stay tailored to your exact logic forever. Spoiler, they won't. And that's where the drawdown trap begins.
This is where modern portfolio theory comes in. When you combine strategies with low or negative correlation, something mathematical happens to your risk profile. While EA number 1 is sitting in its inevitable 8% drawdown during a ranging phase, EA number 2, designed for mean reversion, is hitting new highs. The combined result? Your total drawdown drops while your expected return stays consistent. You're no longer looking for an immortal algorithm. You're building a team of specialized, simple algorithms that hedge each other's weaknesses, multiplying your Sharpe Ratio.
Let's look at the real data. Here is EA1, a momentum strategy on indices. Over 2 years, it's profitable. But look at this 4-month drawdown period of -12%. On a prop firm account, you're on the brink of failing. Now look at EA2, an Asian session mean reversion EA on Forex. It stagnates during high trends, but prints profit right when EA1 struggles. Now look at what happens when we run both together in an aggregated portfolio setup. The max drawdown drops from 12% to under 4%. The equity curve transforms from a violent roller coaster into a smooth curve. Shifting my focus from searching for one magic EA to building decorrelated portfolios was the single biggest turning point in my trading career. These payouts and certificates aren't from guessing market direction. They're the direct result of controlling variance through aggregation. When you protect your downside with math, passing prop challenges and maintaining real capital becomes a structured, repeatable process. Now, you might be asking, how do I actually build an aggregated portfolio in practice without blowing up my margin? Most traders make a fatal mistake here. They look at asset correlation, for example, EURUSD and GBPUSD, and assume that if they trade 2 different pairs, they are diversified. They are dead wrong. What actually matters isn't the correlation of the underlying market, it's the correlation of your system's equity curves. Here is the 3-step protocol you need to follow. First, calculate trade-level correlation. Log the daily returns of each EA and run a Pearson correlation. You want your individual system equity returns to have a correlation score below 0.30, or ideally negative during high volatility periods. Second, apply volatility parity. Never use equal lot sizes across different algorithms. An EA trading gold with a 50 pip average true range requires completely different risk sizing than a scalper on EuroCHF. You must scale your position sizes so each EA contributes the exact same risk percentage to the portfolio daily. Third, implement a portfolio circuit breaker. Even decorrelated systems can temporarily align into a simultaneous drawdown. To guarantee prop firm compliance, deploy a master risk management script that monitors your total aggregate equity. If the entire portfolio hits a 3.5% daily drawdown, it immediately closes all positions and pauses all EAs until the next session. When you protect your downside with math, passing prop challenges and maintaining real capital becomes a structured engineering task, not a gamble. If you found this quantitative breakdown valuable, hit the like button and subscribe to the channel for more algorithmic trading research.
Drop a comment below letting me know, are you currently running a single EA or are you building a portfolio system? I read and reply to every single comment. Thanks for watching, keep coding, and I'll see you in the next video.